Guy, have fun now.
Omo, I'm not really fine. Do you know they paid me last week and right now I can't even boost up to 10,000 naira in my account?
Seriously?
Yes.
Did you budget?
Which one is budgeting? I'm not a politician.
That's when your money is missing like NEPA lights.
But I didn't buy anything serious, shoes, bags, the thing that guys need now. And just like that, fiam, the money has disappeared.
But it's all these little things. That's what is taking your money.
But what should I do?
See, you have to create a budget. You have to track your spending. You have to prioritize your needs over your wants. And you have to save before you spend, not the other way around.
So what you're trying to say that this money management thing is no child's play?
It's no child's play at all.
The Money Click is an annual financial literacy program to help you up your money game. The Money Click is not just about money, it's about mindset. So in the Money Click program, go beyond budgeting to rewire your thinking, to rewire your mindset, to change your thinking about income, to change your thinking about money management. So we'll help you grow your income, we'll help you manage it, we'll help you invest with confidence. Money is not just about what you know. Money is more about how you behave. And every day in the Money Click program, what we'll try to do is to influence how you behave about money. This is not just financial education. This is financial transformation. I will hope to see you become a part of it. Thank you.
All right, okay. Well done, everybody. Good afternoon. My sincere apologies that I'm here late. I'm so sorry. Apologies, please. I see that you've all been waiting. Sincere apologies, please, that I'm here late. I just needed to catch my breath a little. Now, trying to catch my breath, that's how the network started misbehaving, right? That's how in fact, right now, my devices are hanging. My laptop is hanging. My phone is hanging. Everything is hanging. Thank you so much, everyone, for being here. Thank you so much, Sal. I see you. Thank you so much for joining me here. For those who were in the TIP session, thank you so much for. So for those who are in the TIP session, thank you so much for joining us in the TIP session. It was an amazing time in the inner circle. Apologies, sorry, my device keeps muting itself. Okay, all right. Sincere apologies once again. I don't know why my device keeps muting itself. So thank you so much, everyone, for being here today. Thank you for joining me. Thank you for joining me in the TIP session. Thank you for joining me back here. Thank you for being patient enough to wait for me to come up here. Please, I'm so sorry. And I do not take it for granted that you made out your time to also be here with me today. Thank you, and thank you. Thank you cannot be enough. Thank you so much. I see you, everyone. Sir FOB, I see you. Madam Jamila, I see you. Madam Linda Oko, I see you. Madam Wafo, I see you. Or Madam Annie, I see you. Our cohort leader, cohort 2 leader. Thank you so much. I see Mr. Christian Wosu. Thank you so much, everybody, for being here. We'll just get right into it because I don't want to keep you waiting any much longer. Yes, village people are very far from this class. Okay, all right. Thank you so much. Okay, so today we want us to look at the difference between speculators and investors, right? The difference between speculators and investors. So the moment you start speculating, you're gambling. So we can also say we want to look at the difference between gamblers and investors, right? So you can have speculators in the same markets. You can have investors in the same market. So gambling or speculating is not only what it is when we're doing it on sports betting platforms or platforms in code that are known for gambling, right? At the point when we start approaching investing in a certain way, even in the stock market, it becomes speculation, right? So two people can enter the stock market with the same amount of money, and years later, one builds wealth and the other loses money repeatedly, right? The other loses money repeatedly. Okay, So the difference is not luck. It's not luck. That's not the difference. The difference is in the mindset, and it is in the approach they bring into the market. Right? At the core of this difference are two types of people: speculators and investors. Now, let's look at what a speculator really does. A speculator is focused on price. Speculators are people that they're always asking, hey, how is it moving? What is moving now? Like somebody asked me a few days ago that what stock can he put his money in now? And in 3 months later, he will take it out doubled. There was a group we created for stock, a free stock guy, and the person was in that group. And that's a question. This happened just a few days ago. And somebody was asking me this question, just a few days ago. All right. So speculators are asking what is trending. What is trending? What is on board? Right? So I'm asking where can I make quick money? These are the kind of questions speculators are. So you find yourself in a position where you are asking the same kind of questions. You are speculating. You've become a speculator. You become a speculator, right? So there are people that their decisions are driven by hype. It's driven by news. It's driven by social media. It's driven by rumors. They are not buying business. They are betting on price movements. There's a difference. There's a difference when you're buying a business and when you're betting on price movements. Right? When you're betting on price movement. So the moment you start putting your money and you're betting on price movement, at that point you're speculating. You're speculating. And there's a way speculators think. And I want to explain it so that you know that at the point when you start thinking this way, just know that at this point you started speculating. Right? People, the way to let us think is they tell themselves, let me enter before it blows. Let me enter this stock now before it blows, before everything will come out. Just like how people entered some form of investing like MMM and the Red and CBEX, they saw that to happen, they say, let me enter now before everything scatter. Speculators tell themselves, I will sell when it rises. Speculators tell themselves, I can't miss this opportunity. But you know the problem. The problem is they often enter late and they often exit too early, or they exit too late and they react emotionally. Right? So speculation creates very inconsistent results. It creates emotional stress. It creates frequent losses. The problem is, as a speculator, you are trying to outsmart the market in the short term. That's the problem. You're trying to outsmart the market in a very short term. And that's a difficult thing to do. That's gambling. Now, let's look at what investors really do, right? Investors, first of all, number one thing that investors are focused on is on value. On value. So investors are focused on value. Value first, right? So investors are asking themselves some questions. Is this a good business? Is this a good business? Will this company still exist and grow in the future? Am I buying at a reasonable price? It's not just about entering the market. It's not just about getting in. You need to understand the business that you are buying. Remember, when you buy a stock, you become a shareholder in the company. So you need to ask yourself, this business I'm putting, the problem is that most times, and especially speculators, they don't see stocks as businesses. They don't see the business behind the stock. An investor sees the business behind the stock. So you need to look at the business behind the stock and you need to query that business. Is this a good business? At that point, you need to stop thinking that this business is on the stock market. Just think about it as somebody coming to you and telling you, come and put your money in my business because I want you to be a part of it. You need to think like an entrepreneur. What kind of business is this? Is this a good business to put my money in? You need to ask yourself, if I put my money in this business, will this company still exist and grow in the future? Is this a company that 5 years later will start looking for them? Is this a company that can stand the test of time? Is this a company that in the next 20 years, I am sure that this company will still be in business? Is this that kind of company? That's how investors think. You need to ask questions around the business. And when you decide you want to even look at the stock, the first question you need to ask yourself about the stock is, am I buying this stock at a reasonable price? Just like Benjamin Graham has told us, you can buy a good stock at an overprice. You can overprice a good stock can be overpriced. So you can buy a good stock where you're buying it at a very exorbitant price, at a price that does not give you a margin of safety. What is a margin of safety? A margin of safety is at a point where the stock is at a low point, where if you buy, you're sure of one thing: it's either it remains there or it goes up. But when you're buying at an unreasonable price, it means you're buying at an overpriced point in time, right? You're buying at a price that is over what that stock should sell at. Even though it's a good company, you might still buy it at the wrong price, and that would affect your outcome on that stock. Why? Because you might be buying it at the time when they are overly overpriced, and before you know it, everything is corrected, and the price comes down, and you see yourself losing out. So you must always buy at a reasonable price. And what do you use? What tells you if you're buying this price at a reasonable price? You need to check the price to earnings ratio. See, it is the relationship between the price and the earnings that tells you if this is a good price or it's a bad price. It's not just looking at the price alone, right? Of course, later on in subsequent classes, we're going to come to understand these ratios are. What is PE ratio and the rest of them. So as an investor, you're not chasing movements. That's not the goal. The goal is not to chase the movement of stocks. That's why it's funny when people come and say, "Oh, how do I stop checking my the stocks every minute?" It's because you're yet not thinking as an investor. You're thinking as a speculator. As an investor, your focus is ownership. You're building ownership. Your focus is, I own the stocks now. I'm a part owner in this Coca-Cola company. Right? So your focus is not on the movement of the price. So you need to think like an investor, if you must act like one. Right? So you need to ask yourself, what am I actually buying? What am I actually buying? Does this business make sense on the long term? Can I hold this stock for years? There are stocks you know that, this company have come to stay. There are companies that when you look at their financials, right, you will know that give them a few years, these people will pack up. And remember, since you've become a part owner of the company, if you buy shares in that company and they pack up, your money will pack up with them. Your money will pack up with them. Just like some of us have invested in some companies and stocks before, and the companies folded, and so went the money. So you need to be looking and asking the right questions, right? You need to be asking the very, 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 very right questions. Okay? Intentionally. When you ask the right questions, you get the results of investing. And what are the results? The result is steady growth. The result is lower stress. The result is long-term wealth. And you can only achieve all those things if you allow time and compounding to do the heavy lifting for you. So it's not about you put money today and you're looking to bring it out in the next 6 months. That is not investing. And that's the reason why in the last class yesterday, I talked about things you have to put in place. The financial foundation you must have before you start investing. Part of that financial foundation you must have is that first, you must have an emergency fund. Second is that you must do away with high interest debt. Third is that you must have what's the third thing? You must have a stable income. So you are investing with money that you know you can do away with for now. Don't use money that you've planned to use pay rent to go and put in the stock market. No, please. That's why you should have a separate budget for investing. Right? So it is money you know that you are ready to let part with it for the next few years to come. You're not going to touch it. You should just go there. It will be breathing, it will be working for you, and it will be bringing you the compound interest will be doing the heavy lifting for you. right? So there are core differences. There are core differences between speculators and investors. And we're going to look at those core differences with different approaches. First, we're going to look at the core differences in time horizon. We're going to look at it with focus, decision drivers, and risk approach, and then behavior. What do I mean? Now, when it comes to time horizon, speculators are thinking short term, right? They are thinking in days. Speculators think in months, they think in weeks. Investors think long term. Investors think years. Investors think decades. Right? In focus, speculators focus on price. Investors focus on value. That's why that book, The Intelligent Investor, they will say it is a book on value investing. A book on value investing. They call it the best book of value investing. Even Warren Buffett himself agreed that this is the best book of value investing. So your focus as an investor is value, not price. Not price. The first focus is value, right? The decision driver, speculators make decisions based on emotion and noise. Dangote refinery is coming up. Everybody is buying IPO at Dangote. You go and buy. That's you being a speculator. That's you being a speculator. Because what is moving you, what is propelling you to move into the market is nothing but emotions and noise all around you. Now, what makes you an investor at that point is you sitting down to research and take a logical approach. You asking yourself, is it a wise decision right now to get to buy Dangote refinery? Oh, okay, I want to know how much is Dangote refinery making, right? What is their profitability? How is their financial health? Do they have debt? How much debt does Dangote refinery have to pay? And looking at the business that they are in, will they be able to complete this debt in the shortest possible time? What are the challenges that Dangote refinery will be facing in Africa, in Nigeria especially? Can he surpass these challenges? You need to research and you need to take a logical approach with your decisions. It's not by emotions. It's not by saying that Dangote is our own. Let's invest because it's our own. No. Everything must have a reason. You must have a reason why you're doing it. Right? Then another core difference is in the risk approach. The risk approach. Speculators take very high risk. Right? They take high risk with uncertain outcomes. Investors, on the other hand, manage risks and take calculated decisions. So there are ways, just like in the book that we've read, there are ways to manage risk in the stock market. And even the number one process of managing risk is first acquiring the right knowledge about the market. But as a speculator, you just tell yourself, business is high risk. The higher the risk, the higher return. You jump in, wow, without doing any due diligence. I'll tell you a story about this thing, about this high risk. So something happened years ago, 2016. So with a very good friend of mine, who was also my best man at my wedding. So we went to my house in the Owerri to spend Christmas then. And so we decided that we were going to go to the swimming pool to go swim. And then I asked him, do you know how to swim? He said, yes, why not? That he swims their river in Ihiala. He's from he swims in Ihiala river. I hear that is a fish. What am I saying? I should not ask him that question again. No, please. That this is not children. If I want to disgrace him, not in public like this. I said, "Oh, okay, now no wahala. Since you can swim, let's go." Got to the swimming pool, and the first thing he didn't even ask any questions. He didn't ask where's the deep part, where's the shallow part. No questions at all. My friend jumped into the pool, and the next thing that we saw was somebody did. So luckily, and as at that time I wasn't really very experienced in swimming. I had just started learning, right? There I could swim, but I didn't do certain things. So I wanted to jump in, instinctively to help my friend. But luckily, there was the lifeguard that was there. And he said, no, don't go yet. Let him relax. Let him, he's still struggling. Let him stop struggling first. If not, he will drown the both of you. So he let my guy take in just a few cups of water. Then he went in and he brought him out. Story for another day. He said that guy is wicked, that he almost died and all that. But the lifeguard came to explain to me that this is the reason why I took this decision. Even for me, if I went in at the time when I went in, with the way this guy was struggling, he would drown the both of us. Right? And when you look at that, you get to look at it in the terms of spectators and investors. My guy jumped in like a spectator. He was reactive. And I was almost going to be reactive as well, right? But I was held back. And one thing that held investors back is intention. We need to be intentional, and we need to calculate our decisions as investors. If the lifeguard did not calculate his decision, he would have jumped in and he would have had an uncertain outcome. And that uncertain outcome was that he would have been dragged down into the deep part of that pool with my friend because somebody was struggling. All he will try to do is to hold you and press you down for him to come up. And at the end of the day, the both of you might just drown. So he managed the risk. He calculated this decision. I was very intentional about it. And this is how we approach the stock market as investors. We need to calculate our decisions ahead of time. You need to ask yourself, what are the risks that I stand to face? Right? If the lifeguard has jumped in without calculating his risk, he would put himself even at more risk. But he calculated the risk and he took a very calculated decision. Right? That was based on his own skills. Maybe there's somebody who could have saved my friend, even though he was struggling and all that. Maybe, but that was based on his own skills. So you also need to manage your risk based on the amount of education and skills that you have. Right? The amount of skills and education you have. So let's look at a different kind of example. Let's imagine two people buy shares in the same company. People, the same company, they buy shares in the same company, right? Person A, who is a speculator here, he buys because the price is rising. So he just gets in and he sees that, this price is going up, and he decides to buy, right? And he bought because the price is rising, and every hour he's checking his app, just like some of us do. Every hour he's checking his app to know if this price is moving, where it's moving to, right? And he panics if the price drops. And then if it seems like it's dropping too quickly, he will rush and go and sell. That's a speculator. So it is not that what makes you a speculator is not you putting your money in a different place. You can be a speculator even in the right stock. Then an investor, on the other hand, is somebody who studies the business, who understands the growth potential of that business. So even if there's downward movement of the stock in the price at that time, he knows that no, this business is too profitable. It's too profitable. I've forgotten the story, the particular business that this thing happened with Warren Buffett. The business was going down, and people thought Buffett was crazy. As the business was going down, Buffett looked at this business and said, no, this business will stand the test of time. He went all in on that business. Right? And today, that business still stands. If I remember the name of the company, I'll let you know. That's how an investor thinks. You ignore the short-term noise. There are some noise that are short-term. Right? You hold for years. And that's what brings you the returns that you need. So you see, same stock, different kinds of people, different kinds of behavior, different approach. So two people can invest in the same stock with different approach. One is a speculator, one becomes an investor. One becomes an investor. So, oh, wow, interesting. Interesting. Thank you very much for sharing. So, Sally Music says, Sally Muse, right? I hope I got it right. Yes. So says that I've had this experience with a friend too. I almost drowned with him. It's a flying boat that came to our rescue. Oh, wow. Wow. Interesting. Interesting. Oh, that's interesting. Yes. Yes. Oh, thank you very much. Thank you for what's the word now? Thank you for telling us the truth, sir, about what you've been doing. Thank you. But today you need to turn around and change the wheel and move from the speculator to an investor. Right? You need to move from a speculator to an investor. So most times when we talk about speculating, people feel that, oh, it's about where you put your money. No, it can be the two people can invest in the same stock. One is speculating, one is investing. It all depends on the approach. It all depends on in the investor's behavior. It all depends on the decision drivers. It depends on the focus. All right? It depends on the focus. So there's nothing really inherently wrong with speculation, right? There's nothing really wrong with speculation. But the danger is speculation without knowledge and discipline quickly turns into gambling. So you speculate well enough without the right knowledge and discipline, you turn it into a gambling. Right? And most people don't have a strategy. Most people don't have risk control. Most people don't have emotional discipline. So they lose. They lose. Right? But what you need to change everything first for you is a mindset. Right? You need a mindset shift. Right? So the moment you shift from how much can I make quickly, like a lot of people come to ask me, and you move to what am I building over time, everything changes. You become more patient. You make better decisions. You stop acting to noise. You start thinking like an owner. You start thinking like an owner. So the stock market rewards different people differently. It rewards speculators occasionally, but it rewards investors consistently. So it's not that speculators would always lose out. They will lose, they will win sometimes, but occasionally. And that's why when I see people who get into stock trading, right? The way they get into it, I laugh because most times they get in with very little knowledge, right? And before you know it, it turns into gambling because they will win just a few times, and most times they hear that they're losing money. Especially also people who get into forex, they don't even understand anything about it, and they get into it, and you see them just losing money. So when you're speculating and you're speculating without knowledge, it's even more dangerous. It's more dangerous, right? It's more dangerous. So the stock market rewards speculators occasionally, but it rewards the investors consistently. But for you to mark yourself as an investor, you need time. You need time. You need time. You need to give yourself time. Time is what brings you the return. I'm not talking about you put your money today and 1 year later asking coach, should I sell now? Remember, it's about ownership. It's about ownership. The reward that comes to an investor is a factor of time. Why? Because it requires time for compounding to give you what you want. So put the money there. Tell yourself, I'm leaving this money here for the next 10 years. No go touch it. 10 years, yes. 10 years seems actually far, but it's not. 10 years is not far. 20 years is not far. That's the truth. It's not far at all. Right? Let that be the resolve. Let that be the resolve. So if you truly want to win in the stock market, you must decide who you are. You must decide who you are first. So are you someone chasing quick wins, or are you someone building long-term wealth? And when you look deep down, you'll be able to answer that question. Because that decision will shape how you think, that decision will shape how you act, that decision ultimately will determine your financial future. And if you want to move from guessing to reacting, if you want to move from understanding to structure to disciplined investing, you need to get the right knowledge. You need to get the right knowledge. And that's why we're going to be having the How to Make Money from Stock class coming up very soon in the month of April. right? Where we're going to look at some other practicabilities and technicalities around the stock market, break it down and make it easy for everyone to understand. It's open to everybody, right? Especially if you're here and you're not in the Money Click program, it's open to you. But also, if you're here and you're not in the Money Click program, you have an opportunity to join today. Just today, we opened 12 hours discount for non-members, for people who want to join the Money Click for March cohort. A 12 hours discount, 10% discount is going to last for 12 hours only, right? So you also have opportunity watching me today to be a part of the Money Click program by keying into this 10% discount, right? Please, this is the time to key in. This discount is going to expire by 12 midnight today, and the price will go back to the normal. Money Click March cohort starts by Sunday, right? And I want you to be a part of it. Yes, your questions. Can the stock market reward be transferred in case where the primary owner dies? Yes. Yes, your dividends can be claimed by your children. Your dividend can be claimed by your dependents. Yes, it can be claimed, right? But to even make things easy so that they don't have to go through the process of, because it's a whole process going through that. Trust me. So to avoid that whole process, it's good that you have somebody, one of your children, or somebody close by who has information about some of these things. Information about where the stocks are, information about access to the account or access to the platform and all that. It makes it easy so that just in case anything happens, they can always access it with ease. Yes, legally by law, they can inherit, your children can inherit your stocks, but trust me, it is a long journey. In Nigeria system is no system at all even makes it easy. No matter where you are, you would go through, you do paperwork, a lot of paperwork, right? You do a lot of paperwork. So just in case also, maybe you have parents that own stocks, because just like we have a lot of unclaimed dividends, right, that are with the registrars at the moment. And some people who own these dividends are dead. And if you have a parent and that have unclaimed dividends, you can go ahead and claim those dividends if you are a dependent of the deceased person, right? So you fill some document, you go show some proof that you're the dependent. So what is it called? Is it dependent? Yes, you're the next of kin. Yes, that's the word I'm looking for. Be phrased. You're the next of kin, right? The proof that you are. They'll ask you for some certain documents, and then when you prove it, then they will start transferring the dividends to you. And that's the beautiful thing about investing. You can keep on gaining from those dividends for as long as the company exists, right? And you can still bequeath it to your children, and it just keeps moving, right? So thank you so much, everybody. Thank you so much, Ma. I see you, Madam Augusta Enyang. Thank you, and thank you to everyone. Thank you so much for being here today. This is where we end today's Thursday live. I feel like my lungs. I need air. I've spoken so much in the last about 3 hours. I've been speaking. So I'll just take a break at this time. Thank you so much, everyone, for joining me today. Remember, we're going to be back here again next week. Next week, we're back on Wednesday live and also Thursday live. My apologies once again for starting this class late. Sincere apologies. Thank you so much, everyone, for being here. See you all next week.